Hi, thank you very much, Victor, for sharing Kepler's insight outlook on the crude developments. Now, turning focus to the downstream market, I'm Jane, and I cover the refined products here in Kepler Insight. So let's start off with a general overview of where the global refining margins have been and where we expect it to be in the next few months. So here on the top right-hand chart, you can see the simple refining margins by region. Okay, and there are two main features of this chart, which would be that there has been hyper volatility post-Russian invasion into Ukraine. So, for instance, Singapore margins in early March actually shot up from -$5 a barrel to $11 a barrel in a week, and which was then a multi-year high. And margins have stayed relatively elevated during the summer season, especially in the Northern Hemisphere, because pandemic refinery closures meant that oil product supply was really trying to catch up with demand. The second distinctive feature is there is no longer a very strong, clear interregional relationship, largely because there has been increased volatility and there's also more product dislocation. So for instance, the US Gulf refining margins tend to be the outperformer in the past, but this has been actually overtaken by the Mediterranean, where we actually view to have more access to cheaper Urals as a feedstock. But of course, some things don't change. The Singapore margins are still the weakest, nevertheless, and largely because we are seeing still continuing the more fuel oil from Russia as well as naphtha that's coming into this region, pressuring an already very weak market. Now, our outlook for refining margins is that volatility should start to ease, which means we are unlikely to see the highs that we've seen in the previous months, for example, especially right after the invasion. But that's not to say that there's not going to be any volatility. In fact, there will still be because there's still a product dislocation between the supply and demand, and that is going to bring about bouts of uncertainty. Okay, but overall levels of the refining margins are expected to be more tempered, actually because there is a ramp up of refining throughput in the Middle East as well as new refineries coming up in China, which would help to cap the product cracks as well. Still, we still expect the levels to be quite elevated compared to historical norms. So I guess one of the biggest developments that have really been brought to the fore in recent weeks is the Chinese allocation of the 13.25 million tons of product export allocation. The question then is China actually going to return to the Asian CPP export market? Of course, we want to note that this is circumstantial. It is really driven and born out of the weak domestic demand in China because of a zero COVID strategy. And of course, of all across the manufacturing industries, refining is quite a rare bright spot, especially against the backdrop of a property slowdown, weaker consumer spending, and overall a softer economic output out of the country. But in spite of this allocation for the product export quotas, we note that the fuel security still remains top concern for China. Of course, there is a bit more encouragement for its refiners to boost exports so that they can actually capture the profitability from the higher refining margins globally. But the volume will really depend mainly on the export margins and the profitability as well. Now, our expectation is that assuming an 85% utilization of the quota, we could see about 600 to 700,000 barrels a day of exports. And if the utilization goes up to about 95%, this would actually be increased to about 800 kbd. Of course, this is all assuming a timeline and expiration date of March 2023 for these export quotas. Now, given the comparative margins across the products, which is obviously favoring the middle distillates, we expect about 40 to 50% of Chinese product exports in the months ahead to be made up of diesel. And why are we discussing so much about China? Because at the end of the day, China's decision and activity will impact regional refiners. So, for instance, when China was out of the market since, well, not exactly out of the market, rather, they actually had a reduced presence, in the Asian CPP market since the second half of last year. This actually really opened up the opportunity and room for refiners in Japan, Korea, and Taiwan to really raise their throughput, and we estimate it to have been about 400 kbd. And this also translated directly into more exports from these countries. So this is what you can see in the bottom half of the chart. You see that a lot of the exports have really been driven by, Japan, Korea, India, South Korea. And it was only really until recently in July, August, when we really saw China raise its exports again, largely because they have um, obviously reduced and a huge drop off in demand domestically because of renewed lockdowns as well. So at the heart of our discussion today is really that there is a supply issue for the distillates that's born out of the impending sanctions on Russia. And of course, the epicenter of where it's happening is really in Europe. So 8 months into the war, there's still a very deep reliance on Russia for EU27's distillate supply, as you can tell um, from this chart. But at the end of the day, the reliance is mutual. Russia still sells about 60% of its exports into EU27, and EU27 countries import still about a third of its arrivals from Russia. This is down slightly from an average of about 34 to 36% last year, but it still remains relatively significant. So one of the key metrics that we will be watching out for in the coming months is really the volume of diesel on water, as you can see in the bottom half of the chart in orange. And an increase would really signify two things, largely because one is that Russia could be finding it harder to place its barrels, or two, that Russian diesel is actually moving further afar. So far, we have not really seen um, a sustained increase. It's been quite volatile, as you can tell, but broadly, the volumes are slightly higher, but we haven't really seen a huge spike. But that is something that we will be watching out for. So then the next question really is, who can buy Russian gas, oil, and diesel? So we've actually seen, based on Kpler flows data, more volumes into Fujairah, Brazil, Turkey, and parts of Africa. But really, the combined volumes out of these countries are really about 200 kbd, and it's really just only a third of what's being sent into EU27. So what can we glean from this is that first, that there will definitely eventually be takers for discounted Russian oil. Okay, but it is going to take time for Russia to really completely shift its entire demand center from EU27 to other friendlier countries. Yeah. And to cope with this, we believe that Russian refinery runs will have to drop to accommodate the slower sales. And we estimate that about 700 kbd will fall off from pre-invasion levels by the end of the first quarter next year, which would be just right after the product import ban in February 2023. Now that we've answered the question of where Russian diesel can go, I think the next question that we have to ask is really, where can EU27 countries really draw its alternative supply from? Now, you can see from the top right-hand chart, there has been an increase in volumes from other parts of Europe, such as regional refiners from EU27, but also significant increases that we've observed out of Turkey as well. Now, the arbitrage supply that usually comes from the Middle East, Europe, and as far as Asia Pacific has so far this year been really impacted and really hampered by strong backwardation. So far we've just seen about 400 kbd, which is about 15% lower than the 2021 average. Out of the US, which is a more which is also another key arbitrage supplier to EU27 is that there has been strong competition for US barrels from the other parts of America, such as, Brazil and Mexico. So where we thought the new alternative supply could come from included India, but India has not really stepped up as much as we had hoped they would be, largely because the domestic demand has been very strong, especially when you compare it on a year-on-year basis. And of course, the Indian government has also, excuse me, implemented a series of export levies on India's product exports, and this has really reduced the export margins for especially the private refiners. Yeah, so where we do see countries that have expanded their market share, as mentioned, Turkey has been one of them, and it really helps that the backwardation has sort of decreased in earlier parts of October, of course, because of the recent refinery outages in Europe. The backwardation for the gas oil market in Europe between the N+1 to N+3 spread has again strengthened to the March levels again. So this would really dampen the arbitrage supply that could come in from the longer haul voyages again. So another country besides Turkey is Saudi Arabia, where we saw its market share increase to about 12% from less than about 10% previously. Now, so the impact of the lack of arbitrage flows is really that it's really kept in check the rate of stock builds in EU27. So currently, distillate stocks are still about 40% below the 2015 to 2019 average. Now, a scenario that would really benefit EU27, which could take a while to happen and to completely reshuffle, is if countries in the Americas, Latin America, as well as parts of Africa, they managed to cut a deal with Russia to import more of its diesel. And so then these countries are able to back out some of its demand for US barrels into Europe. Of course, we do expect that Chinese exports would increase as well, but that is really contingent on how steep the backwardation would be for it to go straight into Europe. But in any case, with China back in the export market as it currently stands, we could see the Asia Pacific to be less reliant on some of the swing supplies out of Middle East and India. And this could again also help to back out some supplies from these countries and regions into EU27. So now that we've talked enough about this diesel and gas oil, of course, we can't forget the other distillate sibling, which is our jet and kerosene. The jet cracks have also strengthened alongside diesel, but as you can tell from these two charts on the right, the recovery has been uneven. If we were to look at the top right-hand chart, we'll see that the Asian regrade continues to be quite deep in the negative, whereas in the Western Hemisphere, because of largely improved air travel mobility indicators as well, Northwest European and US Gulf jet cracks have also been, the regrade spreads have managed to hold up for the most part in the positive territory. And this really correlates to the air travel indicators, versus the pre-pandemic 2019 levels. As you can tell from the green as well as darker blue line, the European and US travel indicators are about 10% below the 2019 seasonal average. And this is really much more improved than the ones that we're seeing out of the Asia Pacific, especially, and a bit of the Middle East, where they stand at about 50 to 60% below the 2019 seasonal levels. And I think this really is attributed to the absence of China, which is Asia's top aviation market, and the world's second, which is after the US, in terms of its seat capacity and share of passengers. Of course, there are some upsides for the Asian market, with Japan, which is Asia's second biggest aviation market, already opening up to visa-free travel for any of the visitors, as well as Hong Kong and Taiwan. But because China, we expect them to remain pretty much out of the market until at least 2023. We do expect that the Asian regrade is unlikely to really move much further towards the positive territory. So it's not just jet that has been affected, because refiners are trying to maximize gas oil diesel supply. We've also seen a huge impact on the mogas market as well. So here on the right, you can see the mogas diesel ton spread. Again, we are really seeing extreme volatility at unprecedented levels. This spread generally does not really sustain in the negative territory for a long time, but this is really where we have been since June this year. So the spread actually first slumped to record lows post-invasion, in response to diesel's price shock, and it has stayed negative until about early May, when data from the US actually started to show that stocks have been drawn down on a very accelerated pace and have fallen to even decades low. So in the span of a month, it has swung to more than more than $200 a ton, especially in Northwest Europe, from as low as minus $200 a ton before, earlier in the first quarter of this year. And I think this was really to incentivize the refiners globally to produce more gasoline. And we do expect that this spread will continue to stay volatile, but to remain in a flat to negative range, largely because the distillate supply issue in Europe is still quite far from being resolved. I think until we have seen a major or really a complete reshuffling of flows, and more stability being introduced, this spread will likely be continue to remain very volatile. So one of the manifestations of a strong surge in gasoline cracks over May to July was really the jump in blend stocks cracks as well, as you can tell from the top right-hand chart here, which really represents the Northeast Asian naphtha to BTX spread, where BTX being benzene, toluene, and xylene. So of course, it has come off largely because the summer driving season has also we're heading into the winter already. But at its all-time peak, this really corresponded with our data of record BTX exports into the US. And what this really impacted the naphtha market was the stronger BTX crack actually briefly supported the naphtha cracks in later part of June, but this was really short-lived because of the wider weakness in the petchem markets. So we do see that there is potential for the blend stock cracks to really test these levels again, especially if, in this if the rebuilding of stocks in the US it's a bit slower than before, especially as we head into the winter season. Usually this is the period of time when, especially from November onwards, US would try to rebuild its gasoline stocks. And I think, if a slower than usual pace of rebuild of stocks happen, I think that could really open up more room and opportunity for the BTX cracks to really rally again early next year. But again, the upside of cracks will be limited as long as inventories are able to absorb any sharp rise in demand. And this is more reflective of the levels of stocks that we see in Europe, because they have surpassed the 5-year averages by leaps and bounds. But again, the caveat here is it really depends on how the refinery outages actually play out in Europe. If it's going to be sustained and it's going to be prolonged, we would expect that the gasoline stocks there would start to draw down at a relatively rapid pace as well. So now focusing more on the naphtha market itself, it also bore the brunt of the global distillate problem. And I guess that's a result of how refiners globally, simple to complex, they are trying to boost their refinery throughput to really produce enough diesel. And at the same time, they are also producing more naphtha as well. And unfortunately, the absence of China's downstream petchem demand And of course, just to give a sense of how big the market here is, China makes up about a third of Asia's naphtha demand. But because stocks of ethylene has been relatively high in the second to third quarter and only recently been drawn down, this has really forced some of the Asian crackers to cut runs or bring forward maintenance. So of course, as mentioned, the cracker run cuts have helped to tighten the olefins balance in Asia, and this has helped to support naphtha cracks in recent weeks. But of course, our outlook is that really without a substantial sustained recovery in China because of its zero COVID policy, the upside for naphtha cracks is really limited. One of the things that we wanted to really highlight in terms of the flows changes is that we have noticed that there are more naphtha barrels out of Russia going into the Singapore, UAE, and Chinese markets. These three countries used to have just a combined share of about 10%, but now they make up a fifth of Russian total naphtha exports. Now, comparatively, this these volumes have actually displaced some of the Japan and Korean shares of Russian naphtha. So these two countries used to make up about 40% of Russia's naphtha market, but now the market share has actually dropped to less than 10%. So turning to the other oil product, which have seen its cracks still deeply in the negative, is fuel oil. We will start off with the economics of power generation, largely because because of the stronger coal as well as natural gas prices. We've seen that high sulfur fuel oil has become the cheapest feedstock to really burn to generate power, currently as compared to the other feedstocks. And this is after we have converted it to a MMBTU basis, which will help to commonalize, the calorific value across the different fuel. So we've seen an increase in fuel oil supply into India, the subcontinent, especially like into Pakistan, Bangladesh, India, and the Middle East. They really hit the record highs this summer and have really stayed above the 2021 average. But we do believe that most of this switch to fuel oil will be centered in the Middle East and Asia, largely because there are less stringent emission standards, and of course, which means lower cost from carbon offsets in this part of the world. And the switch is also more observable given that the power plants tend to be separate. It's usually just the gas power plants versus the oil-fired power plants, whereas in Europe it tends to be co-generational. So it's a bit harder to determine how much switch to fuel oil has happened in Europe. For Europe, we do see the potential to switch to more of a gas oil market. So based on the maximum observed oil demand for power generation, and we come since 2015 and we compare it to 2021 levels, we see an upside potential of about 600 kbd of incremental fuel oil demand from power generation this winter. So of course, this demand for higher sulfur fuel oil has helped to really widen the 180 to 380 viscosity spread as well. So wrapping things up, we'll focus now on the Singapore fuel oil market. I think this is where we have seen quite substantial changes in terms of flows, especially increased volumes from Russia fuel oil into that are heading east, as you can tell from the top right-hand chart. But of course, there are also quite a lot of re-exports from, say, Fujairah into the Southeast Asian market. So to give a sense of how much that is, the Fujairah to Southeast Asian flows have averaged about 230 kbd since April, and this would really compare to less than 100 kbd earlier this year before the invasion happened. Now, what has happened is that the flush of supplies have really led to increased floating storage, which have increased marginally to about 20 million barrels from currently from about 12 million barrels back in April. And this really has translated to weaker fuel oil cracks as well, and really pressuring the fuel oil market into contango, which in turn, again, also incentivizes more storage if the economics allow. And why would we say that if the economics allow? Because current freight rates, for instance, are very strong, especially for VLCCs. So higher freight rates, higher time charter rates could actually be an inhibitor to more floating storage. So a lot of the benefit would really be driven by players who have on-land storage at this point. Now, our outlook for the fuel oil market is that given the persistently weak pricing for fuel oil, our forward pricing driven supply model shows that the global fuel oil balance is expected to really tighten towards the end of this year, especially in Europe. But of course, the East of Suez market might be a bit divergent and different given the flush supplies that's coming in from Russia. With that, I just want to thank you for your attention to this short on-demand presentation that we bring to you in post APPEC. And please, if any questions, feel free to reach out to the Kpler Insight team. Thank you.